Hi guys, welcome to week 5 of the YouTube economic and equity analysis. Don't have Andrea here with me this week. I do have one of our other colleagues, Oscar, one of our investment associates. I'll do the usual, talk you through economic data, and Oscar will speak through this week's equity action. Yeah, real big news of the week. Bank of England pushing rates to 0.5%, a 25 basis point increase. The theory is very simple around this. Rates go up, debt becomes more expensive. People have to then, well, they have less to spend, and that impacts company profit and returns down the line. You've got to bear in mind, rates have been below 1% for more than a decade now. And yes, it might be a back-to-back rate increase. It's more substantial than last time, but we're still only at 0.5%, and money is still cheap. We have the impact on the market. There is data there. 2016 to 2018, the Bank of England moved rates from 0.25 to 0.75%, and during that period, the FTSE 350 rose a little over 10%. It's slightly different now. Essentially, you're paying for future growth whenever you purchase any company. Rates affect the discount you get now for the future in terms of prospects and demand. So at 0.5%, where we're at now, £100 today in 10 years' time is only worth a little over £95. You move rates to 1.25%. Today, it would only be worth, £100 would only be worth a little over £88 in 10 years' time. Essentially, future cash flows are worth less in today's world. The real impact of this rate hiking cycle is the speed at which it's going to happen. We just mentioned 1.25%. That's where we see it going come year end. Some people are throwing around 1.5. Personally, I don't think we'll creep that high. And it's the speed at which them hikes are going to come along. And we don't even see the end of the rate hikes through this year. We do believe this will be the beginning of a 2-year rate cycle. Like I've mentioned, I don't think they're priced in yet. And you will see at the time lag, a drag on equity markets in the UK. Yeah, you've got to remember this, and this is really important. People think instantly it's a bit of a myth, but you see people flocking for banking stocks during a rate hike cycle. You've got to be really careful here. Your lending banks will do very well. Increased rates is increased profit for them. But your investment type of banks won't see the same benefits. And while there is some really good banking opportunities and financial opportunities out there, again, you've got to be careful. ECB were again adamant that they're going to do nothing in terms of rate for this year. And you've got to also figure in UK banks have exposure to Europe, where rates won't change, and also you're still going to have very low rate over in Asia, where they do have exposure at the same time.
We focus a lot on jobs data, especially out of the US, and you mentioned we won't get the full picture until February when the counting mechanism reverts back. How's it looking after the release?
Yeah, we've been waiting for this one, and this was a big week in terms of the job data. Counting mechanism is returned to normal. We've now filtered out kind of the change for the temporary and holiday staff. In all honesty, the job data was a disaster for the Fed. There will be some real panicking within the Fed right now. Payrolls added 467,000 jobs. And I mean, hands up, pretty much all economists got this very wrong. Estimates were only at 150,000. Omicron and other things were kind of factored in and presumed more of an impact than they've actually turned out to be. Not only have you added huge amounts of jobs, hours worked again reduced, while wages again increased ahead of estimates. And you know where that takes us? Back into the whole issues of the inflationary cycle. It's not going to go away, and this data, we say the Fed will be panicked. We all expect a March increase. We figured in probably 25 basis points. You could see a real shock to the market in March with 50 basis points announced. And that will simply be on the back of this. This data is potentially the tipping point on what's been a sleepy Fed to this point. We're getting the hawkish tones, but like I say, I think you might find data from last week, that was the tipping point, and we could see some real volatility return, especially when we start getting inflation data on the back of the job data. There's real problems ahead. Obviously, job data spiked bond yields and is pretty much contributed to what has been markets generally lower across the week.
We have a couple of requests for your thoughts on the UK housing market. How is it looking?
So, a couple of people have asked us to touch on the housing market. You can really expect the housing market to level off through 2022. That said, that shouldn't be confused with prices leveling off. We expect to see house price increases just keep continuing. We've recently had December data a couple of weeks back. That showed a house price increase, the Halifax House Price Index, up 9.8% year on year. Increasing rates, so we've just been through the Bank of England pushing rates. There's an expectation that this puts people off buying, but what you find is quite the opposite. Like we said, money is still cheap. It still is only 0.5%. And you might actually start seeing a period of, as further rate hikes are anticipated, people trying to jump into the property market now while they can still get a slight discount on them rates. On top of that, you've also got banks have really tightened their mortgage lending over the last kind of 12 to 18 months. That will stay in place, but there's enough money around where lending will still be at vast levels. Because banks have tightened over the period, I think we're going to get into a cycle of that becoming more lax. I'm really hoping we're not going to revert all the way back to the olden days and the disaster that all caused. But banks will start to lax the tightness of the lending. And what really, they're able to do that because they've wiped billions off their loan loss provisions over the last, again, 12 to 18 months, 2 years in some cases. Banks are in a really great place right now. There'll be more people than ever trying to borrow money, and that's just going to keep house prices increasing and increasing. There is subtle differences. I mean, prices are stabilising somewhat in cities, but there's a premium on space now, probably on the back of COVID issues. Your more suburban areas, the prices just keep going and going and going. We expect house prices up 3.6% through this year, and that will push higher again into 2023. We do see sometime the end of 2023 potentially being a peak. How that all plays out from that point will very much be dependent on whether we can get inflationary issues under control now. It's very easy for rates to start running away, and that could be a real problem 2 years from now. But it's a bit too early to say what the impact will be. There's a lot will happen between now and then. So this week, corporate earnings will again be the focus. We've seen some real craziness throughout the week. Markets are still hugely exposed to the earning period. Do you want to kind of give me an overview of major corporate releases this week?
Yeah, so you mentioned earnings season. Generally speaking, we are very active during earnings season. This one, not so much. A combination of lack of trust in earnings and anticipated volatility. Netflix in particular spooked us. As for this week, volatility was again extremely high. Two key earnings of note, Facebook and Amazon. Disappointing Facebook earnings saw market futures fall up to 0.5%. Where Wednesday evening had dragged markets, Amazon's release on Thursday added 0.7% to market futures. Many of you will be now wondering whether Facebook is now a buy on the pullback. The answer is no. Despite forward multiples at 18 being cheaper than the S&P, we still consider the stock expensive. Wednesday night we initially believed it was an industry problem in reduced advertising revenues, but Thursday's release of Amazon, Snap and Pinterest showed that the problem is actually very meta specific. It's a simple issue of increased competition in this space. Facebook actually has a lot of smaller businesses advertising within the platform, and it's the smaller businesses that are starting to get squeezed. It could be a buy at around $211 per share on longer time horizons, but we really want to see how the Reality Labs play out with its multi-billion pound dollar drag on bottom line.
I like that you've just mentioned Meta. That was the bad side of social media stocks, but they didn't all suffer. Do you want to talk me through another couple of social media stocks that did well on the back of their releases?
Elsewhere, Snap saw some crazy after-hours price action on the back of earnings release, jumping 60% in a matter of minutes. It's not a sector we currently have huge interest in. We do have 2022 full-year revenues at just over 5.5 billion, but this would represent slowing year-on-year growth. However, 2022 will see Snap become profitable for the first time, with net income of just over 600 million. We will see asset price back at 2021 highs. Pinterest was another after-hours gainer. The stock potentially looks cheap even after the jump. We have EPS growing to $0.93 in 2022 and $1.29 in 2023. Slowing year-on-year growth is the main concern, but we will see 3.1 billion in revenue in 2022.
So where else we gone this week? I'd really like to go back and look at crypto a little bit. We have seen the increases. I think Bitcoin finished the week somewhere around 40,000. Do you want to talk me through kind of where we are with crypto and any potential exposure to it that we're going to open?
Yeah, so we mentioned crypto a couple of weeks ago, coming back to the $34,000 level. It's actually shown a bit of support at this level, and that's where we are comfortable picking up some exposure. Right blockchain is what we have previously traded, including on the Instagram charity account. We do like the openness of investor relations, and they have provided further updates this week, showing they currently hold 5,347 Bitcoin. 450 are produced in January, up 250% on January 2021. Interestingly, Riot were asked to stop mining this week by the state of Texas. Texas is suffering huge power outages, and obviously Riot is a huge drain. You will probably wonder how the mining is allowed if energy usage is such a problem, but the mining is actually welcomed as it flattens out demand on the grid. The good news is that they are getting a very nice premium for the period of non-mining. We won't hold huge exposure, with Bitcoin holdings only around 12% of market cap. Obviously, this number fluctuates on the underlying Bitcoin price, which we see pushing up to 68,000.
That's great. We're going to end this week with, we've had a couple of requests on individual stocks that people would like us to have a quick look at. One of them, Coupang, an e-commerce stock, and again, an online retailer in Hut Group.
Yes, well, I'm happy to give you some thoughts and metrics on Coupang. It's been a rough ride for investors, and that's unlikely to change anytime soon. The company is doing huge revenue. We have 2022 full year revenue marginally over 24 billion, but gross margins are awful, and we don't see that improving anytime soon. Net losses of 1.4 billion in 2021 will improve in 2022, but still around a billion of losses. Debt is up to over 2 billion, and that will hurt going into the new rate cycle. Japanese equity Macari look a much better alternative. Elsewhere we have Hook Group. Hook Group have really suffered since last summer and currently trade at a 52-week low. The stock's held by 125 institutions and currently 79% held in total. That will provide support at current price levels. A lot of asset price declines have been on the back of US investors exiting the stock, notably Goldman Sachs and a considerable holding by BlackRock selling off. AHL are also beginning to reduce their short position, and downward price on pressure should begin to ease. The balance sheet is decent rather than spectacular, but we won't see a return to profitability until 2023 at just short of 12 million. The move from 52-week low up to 135 pence is where you'd expect to see the price remain for some time.
Well, that's it until next week. Again, we hope you're finding the content useful. Like, subscribe, keep getting in touch, and as you'll see from this week, if people want us to touch on something, we'll try our very best to kind of incorporate that into next week's. Hope everybody has a great week.